Well, for more on the debt threat, Christoph Rieger joins us now from Frankfurt. He's head of fixed income strategy at Commerzbank. Welcome to you, Christoph. Good to have you on the program. So what do you make of the spike up in yields on Greek and Portuguese debt?
Well, certainly one needs to distinguish between those issuers who have been shut out of the market for a long time and probably have no reasonable chance to return anytime soon, and the rest of the pack. And here, quite interestingly, in particular Spain, also certainly Italy and Belgium, had been shielded from the events in Greece, Ireland and Portugal for a long time, but with risk events culminating over the last few days and also supply lined up again later this week, now we're seeing increasing contagion, or at least an impact also on Spanish yields, with spreads also widening there. And thus also we've changed our call here now back to neutral, looking to reduce some risk.
Right, so it means a change in your portfolio. When you say that, is it no good? Is there no reason to buy Greek debt? I mean, is the market looking at a default now?
Well, we have been advising to stay away from Greece, Ireland and Portugal for a long time through all of the rescue packages, simply because all of the packages don't really ensure that we can certainly get to escape this adverse feedback loop that these countries are being trapped in. And as long as this is the case, investments in these countries do remain highly speculative.
How wide could this spread? I mean, you say you're more cautious. Are you more cautious on Spanish debt now?
Yes, the fundamental situation in Spain is certainly much different. And risks do remain that we will see larger implications also on Spanish debt. But up to this point, most of the backup in spreads is headline risk related to the other smaller peripheral countries, as well as a supply concession into a difficult liquidity environment over Easter, with the auctions coming up on Wednesday in Spain. And thus, we don't yet think that really this is the beginning of a new blowout in Spanish spreads to similar levels of the ones that we're seeing in the smaller peripheral countries. And in smaller peripheral countries, to answer your question, it's hard to say really in terms of yield or spread terms where these bonds should be trading. The market is certainly not focusing on yields, but rather on prices, trading these curves rather in terms of expected recovery values and probability of restructuring on default. And in such an environment, in particular, the shorter intermediate maturities certainly have very much upside in terms of yields.
What do you make of S&P's move to downgrade the U.S.'s credit outlook?
I think it's a bullish sign, even for the U.S. Treasury market, ironically, certainly for bonds. The near-term implications are another element of this risk-averse environment, which I was already describing for other reasons. And so also, at the end of the day, even yesterday, starting to help the U.S. Treasury market after an initial sell-off. So we are seeing some developments of relative underperformance against the swaps curve, or some U.S. Treasury curve steepening also against the Eurozone curve. But at the end of the day, it may not be so bearish after all, even for U.S. Treasuries. And in the longer run, with more fiscal restraint now becoming even more inevitable, also the growth prospects for the U.S. are likely to look somewhat bleaker, and therefore also medium to longer term, if the fiscal challenges are being addressed, it may not be so U.S. Treasury negative. And certainly it highlights one thing, that bonds, in particular German AAA rated paper, are the asset of choice right now.
So taking some risk off the table in Europe's periphery, but the move from S&P is bullish for Treasuries. That's Christoph Rieger there from Commerzbank. Thanks very much for being with us.